derivatives are financial contracts that derive their value from an underlying asset. They are tools used to manage risk or speculate on future prices. Mortgage-backed securities and credit default swaps are the two derivatives that played a role in the global financial crisis. These are bundles of home loans sold to investors as a single product. As homeowners repay their loans, investors earn returns. This seemed like a win-win until the system grew unstable. Then credit default swaps entered the picture. A CDS is like insurance for loans. Investors pay premiums to protect themselves if borrowers default. But when too many defaults occurred, even the insurers couldn't cover the loss. Together, MBS and CDS played a key role in the 2008 financial crisis, teaching us that unchecked innovation in finance can lead to devastating consequences.
In the early 2000s, there was a housing boom in the US fueled by low interest rates and banks giving out risky home loans called subprime mortgage. These loans were often given to people with bad credit, assuming that home prices would keep going up and borrowers would pay eventually. But here is the twist. Banks didn't just keep those risky loans. They bundled them into packages called mortgage-backed securities and sold them to investors worldwide, claiming they were safe investments. By 2006, the housing market slowed down and home prices started falling. Many borrowers couldn't afford their payments and defaulted on their loans. Suddenly, all those called safe investments tied to these bad loans lost their values, and banks holding them faced big losses. In 2008, the situation spiraled out of control. Big financial firms like Lehman Brothers collapsed, and others like AIG had to be bailed out by the government. Banks stopped trusting each other, freezing credit and spreading panic across the world. There is the role of MBS and CDS in financial crisis. Banks bundle risky home loans into mortgage-backed securities and sold them to investors, assuming these were safe investments. However, many of these loans were subprime, meaning they were highly risky. To further reduce their risk, banks also sold credit default swaps, which act as insurance against losses if the MBS underperformed. When housing prices fell, many homeowners defaulted on their loans. This caused the value of MBS to reduce. To offset losses, banks created even riskier products such as CDO, which were essentially bets on MBS performance. Investors believed these products were safe because they had high credit ratings. However, the ratings were misleading as the products were much riskier than they seemed. When default surged, companies selling CDS like AIG faced massive losses and couldn't pay the claims. This created a chain reaction, freezing credit markets and causing major financial institutions to collapse. The crisis spread globally, resulting in widespread economic downturns, job losses, and severe financial instability. This demonstrates how poorly understood financial products combined with risky lending and lack of regulation play a critical role in triggering the GFC.
Government plays a vital role to combat the financial crisis that happened in 2008. One of their actions was that the Federal Reserve offers emergency loans to the banks and other depository institutions. It is to prevent some banks from collapse just because the lenders were panicked. Banks could borrow overnight at an above market rate when they had a need for very short-term funding at a discount window on their discretion. Hence, banks were able to cover short-term liquidity and restore their customers' confidence. Other than that, Congress also passed a huge stimulus package in January 2009. It was signed by Obama on 17th of February 2009. They pumped over $800 billion into the economy through new spending, which amounted to $505 billion on new projects and $282 billion in tax relief. Also, it helps to slow the free fall of spending, output, and employment.